Hey, folks. Still waiting on Playboy to actually publish the earnings results. They are delayed at this point. They have been coming out just after the close historically. So we unfortunately don't have any results to talk about just yet until me continuing to spam the refresh button yields something. But we'll we can talk about what the expectations were. Uh, Hopefully, the results come through before the call kicks off. Otherwise, worst case, we will have to review the earnings results after the call. Joe, I am inviting you up to be co-host and hoping you can stream the call audio like we did last time. Once the call comes up in 30 minutes. In the meantime, yeah, still just waiting on results.
Anyone buy more?
Oh, absolutely not. No, waiting. The stock needs to go a lot lower first.
There's a confluence of factors, but I added some right before the close, and I was buying yesterday a little bit.
Your hands must be bleeding.
Still here.
It reminds me of the Stan
Exactly.
dad.
No bell.
Exactly. So okay. Still refreshing. Oh, there we go. Press release is out. Okay. So revenues, huge miss, 10% miss. Revenues from Cap IQ were projected to be 69 million. Revenues came in at 63.6 million. Let's see what margins look like. Actually, before that, let's see how much money they paid themselves in share-based comp this time. Looks like stock-based compensation, $4.5 million. They paid themselves.
That's not bad.
Uh,
And honestly, the
let's
revenue
see,
miss, I mean, people all
7%
their
of
guidance, right?
revenues they paid themselves in the form of stock-based compensation. So another number way higher than what the CFO had asserted earlier this year. To Hedgeye, they had asserted 2 to 4% is what normalized SBC should be, and unfortunately, it remains multiples higher than that. Obviously, it's non-cash, but it's very real, the continued dilution. Did you see what were gross margins, Jimmy?
No, I haven't. I haven't taken a look. In fact, I'm still refreshing. You probably have Bloomberg or something, right? But they didn't have.
I know it was straight on the investor page.
Oh, I see it now. I see it now. Okay. I'll let you continue with some of the highlights, but yeah, I'm surprising. You know, whatever estimates were, the fact that they pulled their guidance and the stock is like cratered. I think the whisper number is considerably lower. I
Ooh, the
think if
stock
they can
is
get,
trading down big time. It's trading at 280 now, another all-time low. It will be interesting to see how much more it drops during the call, because it does not look like Ben Cohn has resigned. Seeing that he is saying, quote, although our short-term results continue to be impacted by global macroeconomic headwinds, we made solid progress in the third quarter against our long-term goals to build out our consumer products business and enhance the Playboy creator platform. We remain hyper-focused on these goals, and I believe we have the right strategy and management team in place to successfully execute our vision for the future of the company. So Ben, not taking any ownership of the failings of himself and his team, digging in, clearly unwilling and unable to acknowledge that. So it does look like we'll have another very deflecting blame to others type call in 25 minutes here. Quite bizarre, truly incredible, the lack of corporate governance in this company due to the shareholder rights agreement that Suhail Rizvi has. It does not appear that Ben Cohn feels any sense of anything, I guess, any responsibility there. So I'm very interested to hear what he has to say in the prepared remarks and in the Q&A. For those of you who recall, last quarter he hyped up why he had not been able to buy stock during the preceding quarter, And since then, the stock has fallen another 50, 60 plus percent, and he has neither bought stock himself nor have any insiders bought stock. So clearly, no confidence in the equity. But uh, yeah, it's just a really horrible result. They don't break out much uh, in the highlight section. Is literally 3 bullets. We get a revenue figure, which the top line did grow year over year, uh, although third quarter results.
The margin came down significantly. I think that's industry wide. It's also seasonally a little bit less than the fourth quarter, but I think it's like 43%. The COGS was about 57% of revenues.
Yeah, I'm going to get this disclosure out of the way for the folks listening. I do need to let everyone know that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. So with that out of the way, yes, we can keep talking. We have 23 minutes till the call will start, which we will play live through here. As you were saying, Jimmy, the deterioration in the gross margin is certainly not a unique issue that PLBY is facing, but it's obviously not helpful in trying to show any sort of profitability. They took a $302 million impairment, by the way. So I've yet to see, and the company is saying that largely driven by asset impairment charge related to the write-down of goodwill, trademarks, and other assets. So whether that's them writing down the PLBY goodwill or the Honey Birdette goodwill, I mean, we'll need to wait for the 10Q to get some more clarity on that. But really, that's all we have is a revenue result, gross margins getting crushed, revenue weaker than expected, massive impairment, non-cash loss, and they didn't really break anything out for the growth of the individual segments. So they simply note that direct-to-consumer revenue grew 22% year over year to $44 million, driven by the continued strong growth of Honey Birdette and PLBY e-commerce. But there's no detail, there's no specifics. There's simply a very sparse statement with a lot of dark red numbers, including that $5.65 per share loss in the quarter. So definitely feels a little like a kitchen sink quarter, just from seeing them take that goodwill charge. You would think that there would be a resignation by some of the failed leadership, but based on the comment from Cohn in the prepared remark, does not appear that he will be falling on the sword yet. But let's see, stock is still trading down from what I've seen after hours. What's that? Trading down to 280 is the last data I see.
Yeah. And at the risk of sounding too bullish, because I think your criticisms have been well documented, rightly so, really. And the fact that there's basically no institutional investors left. There's just some retail shareholders. I think the volatility profile, people can invest on whatever. I think, like you said, this comes off a little bit kitchen sinky. They also, knowing that they probably won't get the benefit of the doubt, I expect more disclosure on the Q, on the call itself. The DTC revenue at $44 million is now over 2/3 of their revenue, which I think is a plus. Again, I said when they pulled their guidance earlier this year, and coming into the year, they had targeted that 350 bogey for some period of time. When they pulled their revenue guidance, I don't know about you, but I said to myself, if this company can grow and get $300 million in revenues, just where it's trading today, it's anyone with a longer term duration, this current management team or not, they'll get paid in the end. So my biggest concerns were dilution, which you pointed out, but also just cash flow management. So when you take out the actual impairment, you go down. I mean,
Well, we
even
can't
if
even
they have
see
a
what
lighter
the
fourth
cash
quarter,
flow
yeah,
situation is because they don't
you're right.
release that. They really, I mean, this company has done an absolutely atrocious job of providing any sort of clarity to capital
Yeah.
markets for how well different segments are performing or not performing.
Sure.
I mean, the press releases provide us with an EBITDA reconciliation and an income statement,
But
right?
forget
We don't
EBITDA. When
get
you
a
can
cash
start
flow.
with
We
net
don't get a balance
loss,
sheet.
you know, it
Right.
looks like they're getting close. Like fourth quarter is going to be a positive net income quarter. And this company, well, we need to see the balance sheet first, right? We don't have any of that. This is pretty bare bones. But when you look at even with the gross margin deterioration, with the impairment, you're looking at some of the other things. You know, they sold the aircraft. They're getting close to break even, so they're not burning cash materially. They had 75 million as of the last quarter. Maybe that goes down a little bit further. But for a company that is worth basically zero in the eyes of the market, I don't know. Again, a lot of negativity is already baked in, and I don't think this company is going bankrupt. Could it get diluted to get that? I've seen other companies really get diluted, but frankly, the dilution today even is, you know, for what we're getting, right? This is not a $20 stock. This is not a $40 stock. This is not a $64 bubble valuation stock anymore. I'm willing to put up with a lot. You know, it's going to get hairy. I'm willing to deal with the hair, and I think anyone who's still long in the name looks at a quarter like this. You know, I saw Allbirds last night. I saw some of the other retailers. It's like it could be worse, and maybe that's all I can say. It could be worse.
Well, I mean,
My biggest concerns today
worse will be a look at the interest expense that they're accruing now. It's up again, big time year over year. The terms of their loan are not very favorable, and
sure.
if we look at their debt to EBITDA, they've utterly failed to generate any sort of EBITDA growth. In fact, EBITDA, I believe, is down from when they actually came public via SPAC, despite buying multiple companies, one of which had positive, EBITDA when they bought it. So management's certainly sending things in reverse when it comes to the results. So it's really just incredible to me that they would assert that they believe they have the right management team in place. And really, I think it's just, again, it gets back to the lack of corporate governance. You have a 5-person board. One member of the board is Ben Cohn. Another member of the board, the chairman, is Suhail Rizvi. He has no concerns given his shareholder rights agreement. He has significant say over what will happen at the board level, and also he can basically veto, or he has almost an embedded veto, if you will, because any change to bylaws require a supermajority. So, it's really just astonishing, I guess, to see that language out of the CEO. So we're going to hear what he has to say in 15 minutes here, and why he's defending his continued double down, triple down, quadruple down into the Playboy creator platform that he didn't even allude to the name Centerfold in the PR. So I wonder if they are going to be shuttering that name at some point. To be quite honest, there's no reason why they shouldn't just be using the Playboy name. That is, in fact, the brand, right? But hopefully we'll get some more color. Management continues to focus all of their time and energy seemingly on that, and the fact that there are no results that they are sharing in the write-up. We should expect to hear some results from them in the call, although I'm inclined to believe there won't be much information shared, but hopefully I'm pleasantly surprised.
Yeah, and beauty is in the eye of the beholder. This is a tricky one. I want to see their balance sheet. I want to see the SBC, like you mentioned.
Well, we can see the SBC. I mean, we need to see how much cash they have, how much cash they burned.
Right.
I mean, that's the stuff to me that matters at this point, because otherwise they need to sell some assets, right? They have, 200 or so million in debt. Ani Burdette could be sold for, I think, at least 150 million if necessary. you certainly don't want to be a forced seller if there's not a buyer on the bid.
See, the
But
thing is, I don't see any insolvency risk though. That's like if they were to shutter all their non-core activities, stop spending money altogether, their physical apparel is printing money, and again, they're going to be cash flow positive next quarter, and it's just a matter of dilution. But in 23, there's so many, pre-profit stocks that are getting created in this environment. This is a company that's cash flow positive.
yeah, I mean, but look, it's not cash flow positive. They're still their SG&A as a percent of revenue was in excess of their gross margin by far. Like it's just
How much was that was
absolutely
centerfold,
unacceptable.
store rollout,
Uh,
and
well, look,
other
I mean, we don't
initiatives?
know because the company doesn't break any of that out and they refuse to. And there's no reason why they shouldn't be providing clarity to investors. So, I mean, again, this is a failed
Agreed.
corporate governance problem. We have, I would say, we retain all rights for any options that we as Wook Capital Management may take or not take regarding our position. Speaking personally on behalf of my personal holdings, I did not opt to hedge ahead of this, although certainly would have been nice to have written $2.50 covered calls ahead of this. It looks like it may trade down there by November OPEX if this after hours activity continues, and if the commentary from the con man or the cone man, excuse me, is not well received. But I mean, it's just baffling the lack of expense management at this company. Like your revenues came in light. You would think expenses wouldn't be growing by 15% year over year on the SG&A line, and yet here we are. I mean, you could back out the SBC from that, and expenses have still grown year over year. So it's just really hard for me to understand what leadership is doing that would lead them to believe that they are the right management team in place to successfully execute, because I don't see any evidence of execution in this result, to be quite honest.
I don't know. I think we have to wait and find out. I'd obviously want to see more disclosure around segment performance, but I don't hate it. I've seen real dumpster fire retail apparel company results this year, this quarter. This is a company that still has some brand heat from the consumer. The margins obviously have deteriorated, not surprising. Year to date through 3 quarters, they've got almost $200 million in revenues. Last year in fourth quarter, their seasonally highest quarter, they do about 33% of their sales. So it's a bit of a stretch to say, hey, can we do another 100 million in this type of retail environment? Maybe that number comes down. You have a company here that's basically trading at 1/2 to 2/3 times 1x revenue. So again, at sub $3,
yeah, but your revenue doesn't matter.
Expectations have to be different.
Blowing away all I mean, that's the problem with this enterprise is that if someone were to step in, buy the entire enterprise, fire everybody, sell off Yandy, sell off Lovers, sell off Honey Birdette, you zero out the debt with that, and you still do have the core licensing business, and you can run a direct-to-consumer business profitably. But that's not the reality that we're facing. We're facing a reality with a management team that can't control costs, that is now taking it on the chin. Gross margins down from the mid 50s is what was estimated by the sell side. 55% GM was the estimate, and we got 42%.
That's lagging though, right? 55 is a strong number. That's best in class for the industry, and I think all the peers have come in this quarter. So, but you're right on the expenses. It's up to Ben to talk about what's in this elevated SG&A expense, what is front loaded, how much of it is attributable to their centerfold digital initiatives, how much is attributable to Honey Birdette expansions, which I think still happened. Some of it got shuttered, but they're still spending money that, again, incrementally, all these stores are four-wall positive, I hope. And, if they think they're an ongoing entity and they have some cash and they're being left for dead, they're going to do what they want to do. And again, I don't have to agree with that. It's clear that there are corporate governance issues, but at sub $3 for whatever your price is without this management team, I don't think it was the worst release. But we'll see what their commentary for the holiday sales is, right? I think the for the Bulls' perspective, if they say, "Hey, we had our best ever Halloween season," and if they can provide some early numbers around year over year, they've been talking about how they were going to have more inventory this year forever. So even with the FX effect, even with the macro headwind, Gen Z has a propensity to spend, and so if they talk about that and they give some type of reassurance about their holiday outlook, they talk about path to free cash flow positive, either literally in the next quarter. If they can provide some commentary on their spending and maybe more run rate. They don't have the benefit of the doubt. Clearly, they've been spending more than they've communicated to. I don't know that they win back institutional shareholders. Just the liquidity profile, the low price stock, all that stuff. I don't even know that there are shorts in the name left. It's just that there's so many names now that have
short interest is the highest it's been yet in the stock. It was nearing a quarter of the float short as of the open today per S3.
So then, there are, whether people are sophisticated or not, there are people that think this company is either going bankrupt or they're going to have to dilute and double their size and raise equity.
Well, I mean, they've been diluting,
which I don't think is.
They just haven't been diluting to raise money. They've just been diluting.
I've seen some real dilution. You've seen the FANG companies. You've seen those narrative growth stocks. Though that's real dilution. This company, it's diluting, but it's. Again, I've seen worse.
And I mean, I don't know how much worse you get than high single-digit % of revenue is in the form of share-based comp. It's just egregious for a company that's bleeding money like this.
DoorDash. You look at these
giving away that much.
There are companies that are still worth $50 billion that are completely unprofitable today that are giving away a ton of SBC. So $7 million. Again, relatively speaking, it's a larger size, but they're not spending money on R&D. A lot of
it also begs the question: what are you paying these people for? You are not a technology company. You're trying to be. You're failing in that endeavor, and unfortunately, that wasted focus from leadership on the failed endeavor is seemingly now detracting from the other business lines. Although, again, it's really hard to say without them breaking down the line-specific performance. Hopefully we'll get some decent questions from the analysts on this with regard to segment level performance. I mean, the Honey Birdette business had been performing well, and the only line we have is that there's continued strong growth in that and Playboy e-commerce, which we don't really know what, have you we know that in the second quarter, for example, in the latter part of the second quarter, they had a very aggressive June sale on Honey Birdette side, and that helped results in the second quarter. They were doing some sales on Honey Birdette side this quarter, but if you're a luxury brand and you're resorting to discounting, I think you're going to devalue your brand quickly. They did, though, release a swimwear line, and of course they are a Australia-based entity with US and UK exposure. So the Australian Honey Birdette, winter, it felt like winter release here if we're in North America, but for Australia, it is the summertime. So we've got that. We also have, they released I think they called it Essentials, which is like a line of less lingerie, more just like underwear and the like. So it would be nice to get some detail on how they're seeing the initial reaction from their customer base on these category expansions that they've rolled out. But again, this is all speculation until management provides some sort of detail. So 5 minutes from now, hopefully we'll get some more detail, and then we can, after the call, see what folks want to talk about and what there is to react to for what management has to say. But
do you recall if there was any guidance given on what the cost of the Centerfold rollout would be for this year? All I know is that they said that the revenue is de minimis, but I don't know how much G&A spend is attributable to that.
I'm looking through transcripts using Centerfold keyword to see, because offhand I don't know if that's been disclosed.
I am curious though. I'm just looking on the after hours. Like who's selling?
265.
Yeah, like who's like what is the thesis for selling down here before the management call,
Yeah,
before
something's better than nothing. Get your money out before it's
And
gone.
again, these are not institutions. These are either high net worth family offices, retail swing
Right, David
traders.
Einhorn has already exited. The only institutions that are really still in, obviously, Builders Union filed a 13G in the preceding quarter.
They're down
Full
probably 50% now.
disclosure, had the opportunity to speak with them a few times, and I think that they are sharp and they do their due diligence. Certainly very uncomfortable to be down on this position so far for them and for us. Um, I do think that right we've got it's November. We've got 50 calendar days, far fewer trading days till the end of the year. So seeing this horrendous result wouldn't surprise me if some folks are starting to lock in their tax losses. I'm sure plenty have already realized the tax loss. So you'll probably have that overhang to work through over the following month and a half.
Yeah, yeah. Um, you know, I'll even though I'm long the stock, I certainly don't have a lot of. I'm not. I'm not like a forever playboy ride or die type person. I'm still looking at it as an investment, and there's a lot of things that are overblown, oversold, whatever. And the market is the market, right? But I don't
Yeah.
know.
So it sounds like I'm looking through the 2Q transcript. There's a comment about tech and infrastructure costs. You're putting it around 7 million this year. That sounded like it looks like it was an analyst's comment rather than the company explicitly answering, but they backed into a 7 million figure for platform build
Yeah,
out cost.
I mean, if they wiped out Dream, you got to think they're spending at least 30 million this year to try to rebuild this platform. So maybe some of that is in there, right? You look at a
Yeah,
Dream year.
certainly hope not. Certainly hope that they'll shut it down. But unfortunately, I think the drunk sailor that's heading the ship knows that he has to resign if he shuts it down. So it seems like he's just doubling, tripling, quadrupling down into the failed initiative. Which, again, there's an annual general meeting coming, and while it is a difficult task, there's certainly there's certainly been there's certainly been Hail Marys that are achieved, and we'll see what happens on the activism front in this stock. Clearly, there's no 13D filers other than Rizvi Travers, uh, who really I've never spoken to Suhail Rizvi. I've heard mixed feedback, some positive, some negative. It's really hard to understand what the relationship dynamic between him as the chairman of the board and the CEO, who is also a board member, is, and why there hasn't been any action taken to remedy what I believe is a strategic failing at the top. But the asset itself is certainly not destroyed. Even if you take a goodwill charge against the value of the brand on your books, it doesn't necessarily that 300 million impairment doesn't relate to what the real economic realities of that asset may be in the future. So, and with that said, it's 4:59, Joe. I am going to assume you've got uh, the earnings call queued up and ready for us once things get underway on their side.
Yep, we're still listening to some terrible elevator music.
Beautiful.
I've definitely been less engaged in Centerfold. I think when it started, I would check regularly just to see how the UI was coming along, how the platform experience is in. I don't know about you, but probably a few months ago, they started doing this thing where like every time you logged in, you had to get that 6-digit verification code to the email. They would never remember your login. It just made it so difficult to even log in, and so that's clearly been an impediment. I can imagine for people who are trying to access it. I just don't know where that's going. Have you had that problem?
Um, I've I the problem I have is that it looks worse than a website that I feel like a 5-year-old could have made. The desktop site is useless. It literally is a mobile website shown for desktop. They've said and asserted that 90+% of their traffic goes to mobile, which is fine and all, but I'm not an active user. I've scoped it out to try and understand what they're doing, but I'm deeply unimpressed by where they sit a year later, with having spent so many millions and so much of their focus being placed on this product. But it's hard to know. They don't share information with investors. So hopefully they'll share some information in a minute here on what the results are that they're seeing. But I do, step back, and I know Joe's probably going to put the audio on in a second, but I do step back and just look at how much the core licensing business had been making. And hopefully we'll get some clarity on China and whether they're seeing issues with payments from Chinese licensees still. But
I'm a buyer at $2.77 a share.
all right, Joe, I'm going to stop talking because I imagine they're going to come on in a second now. And just to recap, folks, the results are out. We reviewed the very limited amount of detail available in the press release. We're going to play the earnings call once it gets started here momentarily, and then we'll resume the conversation following that for, let's call it a half hour to an hour, depending on where things go from there. So I'm going to be muted. Joe is going to play the audio, and we'll be back after the call has wrapped. Appropriately downbeat music for this.
No Tenacious D, Rise Like the Phoenix.
The conference will begin shortly. To raise your hand during Q&A, you can dial *11. The conference will begin shortly. To raise your hand during Q&A, you can dial *11. Good day, and thank you for standing by. Welcome to the PLBY Group's third quarter 2022 earnings conference call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question-and-answer session. To ask a question during this session, you'll need to press *11 on your telephone. Please be advised that today's conference is being recorded. I would now like to hand the conference over to your host today, Ashley DeSimone at ICR. Please go ahead.
Good afternoon, everyone, and welcome to PLBY Group's third quarter 2022 earnings conference call. I'm Ashley DeSimone from ICR. Hosting today's call are Ben Cohn, Chief Executive Officer, and Lance Barton, Chief Financial Officer. After our prepared remarks, we will open up the call for questions when we will be joined by Ashley Kechter, President of Global Consumer Products. The information discussed today is qualified in its entirety by the Form 8-K that has been filed today by PLBY Group, Inc., which may be accessed on the SEC's website and PLBY Group's website. Today's call is also being webcast, and a replay will be posted to PLBY Group's Investor Relations website. Please note that statements made during this call, including financial projections or other statements that are not historical in nature, may constitute forward-looking statements. Such statements are made on the basis of PLBY's views and assumptions regarding future events and business performance at the time they're made, and we do not undertake any obligation to update these statements. Forward-looking statements are subject to risks which could cause PLBY Group's actual results to differ from its historical results and forecasts, including those risks set forth in PLBY Group's filings with the SEC, and you should refer to and carefully consider those for more information. This cautionary statement applies to all forward-looking statements made during this call. Do not place undue reliance on any forward-looking statements. During this call, PLBY will be referring to non-GAAP financial measures. These non-GAAP measures are not prepared in accordance with generally accepted accounting principles. A reconciliation of the non-GAAP financial measures to the most directly comparable GAAP measures is available in the earnings press release PLBY filed with its Form 8-K today. And now, I will open the call to Ben Cohn. Ben, please go ahead.
Thank you, Ashley, and good afternoon, everyone. As we have stated throughout 2022, we had two goals this year: the consolidation of our D2C businesses and the continued build-out of our creator-led digital platform. I am pleased with the progress we have made against both goals in the past quarter. While our short-term results continue to be impacted by global macro and FX headwinds, the quarter was defined by a number of positive results executing against our plan. This inflationary period continues to impact consumer retail businesses with higher costs, rising interest rates, oversupply, and declines in discretionary consumer spending. As a result, our revenue continues to come under pressure, and consumers are projected to pull back on holiday spend. Inventory is reaching peak levels, while consumer demand slows and customer acquisition costs are increasing. Despite this, we have remained hyper-focused on our goals and have taken a number of steps to navigate the challenging macro environment. We have removed nearly $18 million of annualized operating expenses from the company. Part of this reduction includes the sale of the Big Bunny aircraft, which we sold for $17.5 million, generating a more than 2x return on our initial cash investment and more than 10 billion press impressions in under 2 years of ownership. We believe there are further cost reductions to be realized, and we are working towards simplifying our business and reducing operational complexity to achieve those savings. As a result, our business will align around Honey Birdette and our hero brand, PLBY. It's one of the reasons we believe the continued investment in our creator platform is so crucial. Demand for these luxury and iconic brands remains strong. Honey Birdette continues to perform well, especially given the macroeconomic environment and the strong U.S. dollar that continues to impact results. We opened a new store in Short Hills, New Jersey, and plan to open our Tampa, Florida, and Paramus, New Jersey stores before the end of the year. We also began to expand Honey Birdette into new categories and launched the Essentials collection in October. Essentials was the best release of the year for the brand, but more importantly, it attracted a new audience. In its first week, 22% of the Essential sales were to customers who were new to the brand. We will continue to invest in diversifying the product so as to expand our addressable market. We also launched Honey Birdette sexual wellness products at Lover stores to great success, and will continue to replace third-party product with higher margin, owned and operated inventory. Following on the success of our Honey Birdette store in the luxury high-traffic Westfield Century City Mall in Los Angeles, we opened our first owned Playboy pop-up store in mid-October. We are excited to test this elevated mall-based pop-up as a prototype for permanent brick-and-mortar locations targeting the Playboy consumer. The space features rotating iconic Playboy favorites, brand collaborations, and seasonal lines. We are encouraged by its early success. The store is off to a great start. In the first few weeks, revenue is comparable to the average Honey Birdette store in the U.S. The current margin for Playboy's pop-up location is also 7 percentage points higher than Playboy's e-commerce margin, and we expect that to increase as we incorporate more of our owned and operated merchandise into the store. We also continue to make great progress developing those higher margin owned and operated products. Last week, our first true private label consumer product for Playboy launched with Playboy lingerie to great early success. This is the beginning of a larger Playboy lingerie and intimates collection, as well as a full line of new private label products you will see over the next year. Playboy.com continues to perform well, with revenue growth of over 100% through the first 3 quarters this year. Within our licensing business, we're excited about recently launched brand partnerships in Asia, including My Sugar Bae, a trendy Japanese streetwear brand, and an experiential lounge collaboration with retail pop-up and world-renowned nightclub, One Oak, in Tokyo. In the U.S., we set the tone for the ear stacking trend with Playboy and Studs Y2K collection for those who love bold self-expression. We have also launched new collaborations with Oceana Swimwear and global sports giant Lids, which officially dropped in mid-October. Lovers remains down year over year. Long term, we believe Playboy needs to be integrated into or replace Lovers as the brand. We are currently working through our branding strategy and have launched Playboy Pleasure products in Lovers stores. Based on performance, we will begin to solidify our plans to integrate Lovers into Playboy. Yandy continues to struggle for a number of reasons, as we have previously discussed. The traditional Yandy customer has been massively impacted by inflation, and the brand itself is not clearly differentiated within the market. Its trendy products sell at a low margin and have historically relied almost 100% on performance marketing. With the iOS changes last year, the Yandy business has become even more challenging to operate efficiently. We are currently reviewing strategic alternatives for the long-term fit of Yandy within our company. That brings me to the Playboy Creator Platform. Our Playboy Creator Platform is the most strategic opportunity we can continue to invest in. First and foremost, it represents an enormous revenue opportunity as a product unto itself. Second, we believe it can be a highly effective top-of-the-funnel customer acquisition engine we expect will lower our customer acquisition costs across all of our PLBY business lines over time. And third, we can believe it can become the Playboy magazine of the 21st century in its ability to drive enormous cultural relevance and priceless emotional connection with a massive consumer base around the world. On the first point, we strongly believe that the paywall creator space is right for a brand that is aspirational, one that creators are proud to show off their affiliation with, and one that is deemed safe by creators and consumers alike. For nearly 70 years, the pages of Playboy were the place for creators of their time to freely express themselves and monetize their sex appeal in a sophisticated and aspirational way. This brand authenticity makes Playboy today enormously appealing as a high-end space for creators and talent to launch their careers and make money from those fans who are eager to connect with them. We are confident that there is an enormous market share to be taken, given the power of our brand. And the trust we have with the creator community makes us uniquely positioned to win. But of course, brand is not all it will take. We also need to have a product experience and value proposition for creators and users superior to our competition. I'm excited to report today on the immense progress our team has made on all of these fronts. In September, our new product and technology team migrated our creator product to a newly built platform. The goal of our re-platform was twofold: to enable rapid product development to deliver a product to creators and their fans that is as good, if not better, than the competition, and to ensure a sustainable cost base with infrastructure that will scale with the business. Since the re-platform, we have reduced our ongoing tech infrastructure costs by roughly 90%. We vastly improved key functionality for creators, focusing first and foremost on optimizing their ability to monetize their engagement with their fans. For example, we now offer superior messaging capabilities, custom personalized data analytics, and advanced content organizational tools for creators to most effectively engage with and monetize their fan relationships. We are now continuously rolling out data-informed product enhancements and have heard tremendously positive feedback from the creator community. Since the new platform has gone live, the number of creators who are making money in any given week has doubled. The number of actively paying users has doubled and continues to grow week over week. And most importantly, on average, each week, 70% of our creators are making more money than they made the previous week. We're very encouraged by the strong desire we see from top and emerging creators to become part of Playboy, and we're confident that we can provide them with a superior product experience to the competition. We're also thrilled to start integrating our creators more deeply into the Playboy ecosystem in mutually beneficial ways, and more broadly to integrate the creator platform as a massive customer acquisition engine across our business line. Every creator we speak with wants to become a Playboy fashion ambassador. They want to model in a Playboy fashion campaign, and most of all, they want to aspire to join the ranks of the celebrities and influencers who showed up in the pages of Playboy before them as stars of Playboy covers, editorial features, and pictorials. The fact that our Playboy lingerie model search has already generated more than 10,000 applicants less than halfway through the open submission proves that the potential to be on the face of Playboy is an enormously effective creator recruitment tool. These are the creator opportunities that only Playboy can offer. This is our unmatched value proposition. We have started testing our way into building more integrated relationships with creators to expand the benefits we can derive across our business lines. You've likely noticed more of our social posts now feature Playboy creators showing off their favorite Playboy merchandise, and our fashion campaigns featuring Playboy creators. As paid digital marketing continues to become less effective and efficient, with privacy changes and other industry challenges, expanding our own network of fashion influencers and affiliates is of enormous strategic advantage. And of course, as we scale our actively engaged creators, we believe this should exponentially scale the traffic we're generating, thus growing our customer database and helping us drive reduced CAC across the organization. The most coveted creator experiences, like editorial collaboration, fashion campaign shoots, and creative director partnerships, will be reserved for our highest performing and most influential creators. Our Yandy Lana Rhodes collection, released in Q3, was a great early test of how we can execute these special opportunities for creators in a way that drives accelerated growth across our business line. This past summer, we gave Lana the opportunity to serve as a creative director on her own Yandy lingerie line. She partnered hand in hand with our in-house design team to develop her own branded Yandy collection, which was released on her birthday in September. The built-in promotion Lana drove to the collection across her social media channels drove an 84% uptick in traffic to Yandy.com and a 37% increase in daily revenue at a margin 10% higher than similar lingerie. We also saw Playboy creators like Amanda Cerny organically support Lana, pointing to the value of nurturing a Playboy community of creators. We strongly believe that by putting creators at the center of everything we do, we will activate a flywheel of growth across the organization. I'm very encouraged by the accelerated progress our team has accomplished across product, technology, and our creator value proposition. We are well poised to enter this great brand's 70th year, which just so happens to be the year of the rabbit, with great brand and business momentum driven by our creators. With this team in place, we look forward to what we will continue to accomplish together. As I said in our last call, the path forward will not always be a straight line, but our long-term plan is intact, and I am proud of how this team is executing, especially in the past few months, as the new members are beginning to stride. We have one of the biggest brands in the world, and I am confident that the business plan we have is unique, differentiated, and will deliver. I'll now turn the call over to Lance.
Thanks, Ben. Third quarter revenue grew 9% year over year to $63.6 million. Our top line results were impacted by $1.2 million of FX headwinds and a 27% reduction in marketing spend versus the prior year quarter, as we prioritized higher margin spend over revenue growth. On a constant currency basis, revenue growth was up 11%. Revenue in our direct-to-consumer segment was up 22% year over year to $44 million, and on a constant currency basis was up 25%. Similar to the trends we saw in the first half of this year, we continue to see strong revenue growth at both Honey Birdette and Playboy, offset by significant declines at Yandy and to a much lesser extent Lovers. Honey Birdette posted solid growth. Revenue was up 34% year over year to just over $21 million in the third quarter, and on a constant currency basis, revenue grew 41%. As Ben mentioned, we expect to open 3 new stores in the fourth quarter, which will bring our U.S. store footprint to 11 by the end of the year. We've also signed a lease in Boca Raton, Florida, with plans to open next summer and are working to land additional suitable locations in the U.S. and Europe, planning to open in the back half of next year. Playboy e-commerce revenue was up 58% year over year in the third quarter, driven by a 338% increase in email and SMS. We also saw strong results over key holiday weekend sale periods, such as July 4th and Labor Day, due to a significant improvement of in-stock levels across our bestsellers and a strong finish to the quarter from intentionally stocking our Halloween costumes early. The success we saw on email and SMS is a direct result of building out a CRM team and program to focus on customer segmentation, new SMS capabilities, and a digital marketing strategy to reward our loyal customers through early status events and new product launches. It's also particularly interesting given we've not yet started to tap into the email database that the Playboy creator platform brings, which we believe can be a powerful unlock to drive growth and reduce customer acquisition costs for our direct-to-consumer business over the long run. Yandy revenue declined 50% year over year in Q3, while Lovers revenue declined 10%. While the current macro environment continues to negatively impact discretionary spending habits of the target Yandy and Lovers consumer, we're focusing on the levers within our control. This has meant spending less on digital marketing in light of the reduced efficiency we've seen in those channels, ultimately leading to lower revenue but increased profitability. Third quarter revenue in the licensing segment declined 13% year over year to $14.9 million. The decline mostly driven by a $1.7 million reduction in overages that we received compared to last year, as our retail partners are facing similar challenges in the current macroeconomic environment. From a GAAP earnings perspective, we had a number of extraordinary non-cash charges in Q3 that drove our net loss, such as the impairment of intangible assets and inventory reserves. In the third quarter, we recognized around $306 million of impairment charges related to the write-down of goodwill, trademarks, and other intangible assets. The need for impairment was due to the reduction of our financial outlook associated with ongoing macroeconomic uncertainty, along with a higher discount rate being applied to our forecast. In the third quarter, we also recognized $5.9 million of inventory reserves. This non-cash provision was driven by a number of historical factors along with our strategic plan to further consolidate our businesses and improve margins. One major factor is the supply chain challenges that we've encountered over the last 2 years, leading to late arriving seasonal inventory that does not turn as quickly as the inventory that arrived on time. Additionally, the significant decline in Yandy revenue has left us with low quality and low margin wholesale inventory that we need to liquidate as we realign our business around higher quality and higher margin owned and operated Playboy products. As I mentioned on the last earnings call, revenue is incredibly difficult to forecast in the current environment, and as such, we remain very focused on the cost levers that we control. We have made significant progress on our expense reduction initiatives, taking roughly $18 million of annualized OpEx out of the business. This puts our baseline level of OpEx, excluding stock-based comp and other non-cash charges, at roughly $165 million annually, and we will continue to control costs tightly so that we can manage through the current economic environment. These cost reduction initiatives have led to improvements in both EBITDA profitability and cash flow. Adjusted EBITDA for the third quarter was over $700,000, a sequential improvement of $3.3 million despite $1.8 million less revenue compared to the second quarter. Our total cash position has been stable since the end of September, and we currently have over $65 million in cash equivalents, including crypto and restricted cash. Even with continued investment into our growth initiatives, we expect cash flow from operations to remain roughly neutral through the end of this year. We have multiple levers to further reduce costs if circumstances dictate, giving us the financial flexibility to manage within the covenants of our amended credit agreement as we head into 2023. With that, I'll ask the operator to please open the line for questions.
If you'd like to ask a question at this time, please press *11 on your telephone. Please stand by while we compile the Q&A roster. Our first question comes from the line of Alex Furman with Craig-Hallum. Your line is now open.
Great. Thanks very much for taking my question. I wanted to ask about the potential integration of the Playboy and Lovers brands, or using the Playboy brand more to reinvent the Lovers stores. Can you talk a little bit about the timing of when we might start to see this? Are you envisioning Playboy branded storefronts in the former Lovers locations or the current Lovers locations? Would love to just hear more about this strategy and what we could expect to see next year.
Thanks, Alex. And actually, before Ashley and Ben get into that, I misspoke. I wanted to make sure I updated the impairment charges. Were actually $301.9 million of impairment charges, but I'll let Ashley and Ben answer your question.
Yeah, Alex, I'll just start with a high level and then turn it over to Ashley to get into more of the specifics. As we look to simplify and streamline our business, we have a brand that is probably one of the most recognized brands in the world that, in December will be in its 70th year. And the organic awareness and traffic that drives leads us to believe that long-term continuing to transition and rebrand other businesses that don't fall within either Playboy or Honey Birdette makes the most sense to really drive a cohesive ecosystem. With that, I'll let Ashley get into a few more of the specifics on Lovers.
Hi, so jumping in there on Lovers, our first introduction into this is to launch Playboy Pleasure. So we started receiving the inventory on this, and we'll be lights up in our Lovers stores in time for our peak selling for Valentine's Day. We're also evaluating some new store opportunities we have within the Lovers business, where we are going to brand those as Playboy Pleasure stores, and that will enable us to continue to sell the strong merchandise we have through the Lovers brand, but to to exponentially add the Honey Birdette product that we're seeing success in, as well as rolling out a much bigger expression of our Playboy Pleasure product. And so we're going to start with the Playboy Pleasure line and then lead into additional store opportunities that we will either rebrand or integrate into the Lovers business that exists today.
Yeah, and Alex, I think, long term, as we stated, our Century City store is off to a great start as a hero Playboy store. I think that you can imagine that Lovers will be, branded something with the Playboy name in it, but might be Playboy Pleasure or something else as we work through that branding as we enter 2023.
Okay, that's really helpful. Thank you. And then if I could ask also about the licensing business, can we get an update on how the licensing business in China is going? There's been a lot of headlines in the news about continued lockdowns and things like that, and just curious how that impacts your business and what the outlook is next year for that business.
Sure. So we haven't had any revenue impact because, as we mentioned before, our partners pay us in advance. So we've received more payments than the revenue that we've recognized. We did talk about last quarter how we've worked out some payment plans with our partners because they have been impacted by the COVID lockdowns. Their business has been impacted. It's important for everyone to just be aware that they continue to pay us. Some of those payments do get delayed because a lot of people don't know this, but the payments that they make us are subject to a withholding tax at the time that they send out the wire. So current China banking regulations require our partners to pay those payments in person. So when a section of China goes into lockdown, they end up closing banks. Our partners actually can't go in person to make that payment. So that's led to some delays. But what we have seen is as soon as those banks reopen, our partners come out and pay us. So, we're going to continue working with them and pleased with where they are.
Alex, let me just also add, long term, as we sort of think about 2023 and beyond, I think I stated this historically, but for the past couple of years, we believe transitioning our China business into a joint venture would be the most beneficial to provide long-term stability and growth in the market. Over the past few months, we've made substantial progress towards a potential joint venture with a sophisticated operator. And so as we move forward, I think that is the best structure for our business and also provides the most stability and long-term growth, and that's what we're focused on.
Terrific. That's really helpful. Thank you very much.
Thanks, Alex.
Our next question comes from the line of Jason Tilchen with Canaccord Genuity. Your line is now open.
Yep, thanks for taking the question. In the prepared remarks, you mentioned that the inventory in stocks were much better over the summer as you sort of tried to get stuff in stock ahead of the Halloween season. So I'm curious, can you talk about how demand has trended into October leading into Halloween relative to both your expectations over recent months and relative to last year where you saw strong demand but couldn't meet it because of the out-of-stocks?
Hi, Jason. This is Ashley. So I'll speak to Halloween. There are two flavors of the Halloween business this season. So we saw really strong demand and continued excitement around our PLBY brand. And so we delivered a strong Halloween season with continued interest in the bunny suit and also integrated some additional Yandy Halloween costumes into the PLBY business. And we saw that through much of Q3 and then into October. On the Yandy side, which Lance spoke to or alluded to in the script earlier, we have significantly reduced our paid media spend. Last year, we were operating with Yandy in a very different way where we were driving revenue at the expense of profitability and going after top line aggressively. As we've seen the ineffective marketing results as we've looked at, the iOS privacy changes have hit us, we've significantly reduced the paid media side with an eye to earnings. And so as a result, that made top line more challenging for Yandy. And so while we negative comped, we improved our earnings relative to last year. And what we saw, which we feel pretty good about, is we reduced our paid media spend by 2.5 times versus the decline we saw in revenue. So our decline in revenue was significantly lower than the decline we saw in our paid media spend. And again, that just speaks to the earnings focus.
Thanks. That's really helpful. Just one follow-up on Centerfold. It was really great detail you shared about the progress being made there on the tech side. I'm just wondering, how do you view the go-to-market strategy there? Do you feel like the product is at the point where you're going to start, expanding, the outreach to consumers? And also, how do you view the competitive landscape? Obviously, there's some existing players there. Twitter over recent weeks has mentioned the possibility of launching sort of similar tools and services to their users. So I'm just curious how you view the competitive landscape going forward there.
Sure. So, look, I am pleased with where the product is today and the improvements we've made. We've reduced our tech infrastructure costs by over 90%. But more importantly, we are able to roll out changes very, very quickly in the matter of hours or days versus where we were before on the old platform in a matter of weeks or months. There's still room to improve the product. The way we're thinking about what was the Centerfold product, which is really now Playboy as we integrate everything together, that is really our magazine moving forward of the 21st century. And so you'll continue to see improvements to the home screen, to the search functionality. But we know what the consumer is wanting. We know it comes down to messaging. We have started to onboard creators at a faster pace over the past few weeks now that we feel very comfortable with the product. And when we think about the top of the funnel and the integration that it provides for the rest of the ecosystem, you're seeing it through our social media posts. And so instead of just posting a T-shirt and then a creator, we're now posting that creator in a T-shirt. And we've had engagements on our social media that have topped 1.3 million views doing that. And so I remain bullish. I remain that this is the best investment we can continue to make long term. And as Lance said, we saw a massive increase in our email and SMS at Playboy.com. And that's without tapping into the tens of thousands plus of customers that we have, received their email on at Centerfold. And so as we move forward, this is a brand that has worked with creators for the past 70 years. That's really what drove this brand at the end of the day. And that's what we're returning to. And I believe that if we are successful and continue to be successful with the creators that we bring onto the platform, it will not only lead to a very profitable business into Centerfold by itself, but it will drive the rest of the business as well.
This is Ashley. I'll just jump in quickly on that. So one of the other things that we've done to integrate across both our Centerfold business and our consumer products business, we currently have a model search going on through this partner Orbit. We have a goal of acquiring 20,000 additional kind of customers into our file. And what we're seeing is as we have applicants into this program, we are able to shift them into the creator program and have a significant amount of interest from those same applicants to join Centerfold. And so for us, this is a big win where there's a significant amount of synergy between creators that want to be part of Playboy, and that includes participating in whether it's a campaign for lingerie or signing up to become a creator for Centerfold.
Yeah, and I think, look, it's everything we do is going to be centered on one ecosystem moving forward. And the nice thing about the replatforming as well is we now have a technology stack that is very, very flexible. It's current and modern. And as we look to further consolidate the business and integrate products, such as our legacy products, we now have a platform that we can do that on, which allows us to have better operating efficiency moving forward.
Great. That's very helpful. Thanks a lot.
Our next question comes from the line of Jim Duffy with Stifel. Your line is now open.
Thank you. Good afternoon. Hey, I'm traveling. I joined the call late, so forgive me if I'm retreading content covered earlier in the prepared remarks. But Lance, could you give us a rundown on cash balances, liquidity, cash flow projections, and interest expense projections, please?
Yeah, sure. So from a cash perspective, as I mentioned, we're pretty much flat today to where we ended the quarter, right around $65 million of cash equivalents and restricted cash. In terms of where we see things moving forward, our businesses are creating cash flow, right? But we are reinvesting that cash flow back into these growth initiatives around building out that creator-led platform, building out our owned and operated business on the direct-to-consumer side because we see the long-term potential for margin uplift there. So, we could make a choice that we could not be investing back into those businesses and produce more cash flow. We're trying to strike a fine balance here between reinvesting that cash flow into the business, but not investing too much in the current environment. So that's really how we're thinking about it right now. I mean, I also said on the call, we've got a lot of levers right now within our control in terms of of managing our costs, managing investment back into the business. Ben also talked about the replatforming we did on the creator-led platform and some of the efficiencies that we were able to wring out of that. I mean, when you think about it on an annualized basis, you can save, around $1 million just on the infrastructure costs alone based on the work that we've done there. So we're going to continue, again, to make those near-term investments and kind of balance everything in terms of our liquidity needs and make sure that we're living within the covenants of our credit agreement. And like I said, we've got a lot of different levers that we can pull if need be, but I think right now we're managing as best as we can through the current environment, and we feel good about the flexibility that we maintain.
Understood. So through the lens of the leverage profile, you see opportunity to improve the EBITDA, and that's where you see your best focus.
Yeah, I think look over the long term, right? We're really just starting to put out our private label products, and we're seeing it right now with the initial launch of Playboy lingerie. We'll see it with the upcoming launch of Playboy product in Lovers stores. So we see real ability to drive increased, improved product margin there. And yeah, I think these investments that we're making, we've talked about this kind of time and again, we're making near-term investment that we expect to pay off over the long term in terms of margin pickup. I think you'd also asked about the interest expense. I mean, look, hard to know exactly where rates are going to end up. They, continue to increase. Our interest payment this year is still at the LIBOR plus 625. And LIBOR being a 50 bips floor that we're still locked into through this next payment period. But look, next year I anticipate the debt service cost to go up by at least $10 million or more. So we're factoring that into our investment plans for next year, to make sure that we're, like I said, cash flow break even for the year. And that's really what we're targeting, is to reinvest back in the business in a thoughtful way. And preserve cash to weather the current environment.
Makes sense. And Lance, did I hear you say the expense rate $165 million annually? Do I have that correct?
Yep.
Okay. And then Ben, one coming your way. I'm very interested in your comments on the potential conversion to a JV structure in China. Is there a contractual window in the current license agreement that allows you to do that without compensating the licensing partner? And I guess I'm curious what you'd see as the realized margin opportunity versus the license royalty rate that you think gives that strategic justification.
So, Jim, not answer your question, but unfortunately at this time I can't answer that question, as you can imagine, for legal reasons and also just for business reasons. I'll just sort of reiterate what I said before. And look, just to follow up on what you had asked Lance too, what we're focused on right now is continuing to streamline the business. And I believe that we now have the team and the pieces in place. So, you look at what Ashley's team has done, which really didn't get into place until July timeframe, with what they've developed in a short period of time with lingerie, what they have coming over the next year with private label product. All of these things allow us to enhance our margins, and then you start to think about the consolidation of what I would say is these very small legacy businesses into what I would say is hero products moving forward, and that gives us a lot of flexibility moving forward from a cost perspective. And so that's what we're focused on. As we approach 2023, we need to continue to invest in the things that are strategically important. We've seen great growth on Centerfold and in other areas, and Playboy lingerie is off to a great start. Coupled with making sure that we maintain plenty of headroom with our covenants and our cash balances, given no one knows how long the economy will be where it is and if it will get worse or not. But we're planning for the worst and making sure that we maintain maximum flexibility as a company.
Very good. Thank you.
Our next question comes from the line of George Kelly with Roth. Your line is now open.
Hey, everybody. Thanks for taking my questions. So first for Lance, regarding the kind of formula, the guidance you provided about the I think last quarter you called them the annualized non-product costs. Isn't there a second part of the formula, which is what the product costs are on top of that? I think it was 25%. So just curious if any of that has changed.
Yeah, no real change on the product side. I mean, the one thing that we are seeing, and you're obviously seeing this across the board, and you'll see it. You saw it in the third quarter. You're going to see it in the fourth quarter. Is stepped up promotional activity, right? There's a lot of inventory that we've got to move that other competitors in the retail space have to move. So that will have an impact on near-term product margins. But in terms of input costs, they're not really changing in terms of how we're thinking about it over the long term.
Okay.
Yeah, and I'll just jump in on that. So we know there's significant improvement with the owned and operating coming. We are also evaluating other costs related to our fulfillment model, and that's an area where, just from my past, we have an opportunity to reduce spend and cost, and so we're looking pretty heavily into how we can go after savings there across our brands, and then identify obviously the improved product margin and tightened buys on inventory in the current quarter all the way through the front half of next year. And tightening those buys does enable us to really reduce the amount of promo we have to do heading into Q1. We will be up against aggressive promo next year just because we've been promoting through Q3. But we are feeling good about how we've tightened buys, knowing that the economy is slowing.
And that 25% number has been consistent over the last 2 quarters, so it's not moving a ton.
Okay. And then next question. You talked a lot about sort of consolidating and really investing in the core power brands. Curious if that could involve any outright sort of asset sales, or could there be other potential asset sales that you're considering?
So without talking about where we're moving from a strategic perspective at this point, I would say that our goal is to have as many arrows in our quiver as possible, and we will always look at things opportunistically as fiduciaries. But right now, what we're focused on is consolidating the businesses we have around the brands that we know that work, which are Honey Birdette and Playboy. And one of the challenges with the 70-year-old company is you have a lot of small business lines that take back office infrastructure, finance, accounting, legal, HR, et cetera, to maintain. And now that we've seen the traction we've started to see on Centerfold, that allows us moving forward to be strategic in how we consolidate business lines, with the goal of improving our efficiency. And so right now, as we said, we're looking through everything from a strategic standpoint. We think there's a real opportunity to lower our fulfillment costs. And we'll have to think through Yandy long term and how that fits into the Playboy ecosystem.
Yeah, as I say, I mean, consolidation can take many different forms, right? We've talked about the consolidation really on the brand side, and how do we leverage the Playboy brand within Lovers, within Yandy, because those aren't really brands, standalone. We haven't really talked about it on this call, but historically we've talked about the product, I guess, breadth at Yandy, which was historically how they operated with, well over 10,000 to 15,000 SKUs. That creates real fulfillment headaches and challenges when you're a small-ish company like Yandy is. And so part of that consolidation is how do we move through kind of that wholesale, third-party, low-margin, low-quality inventory? How do we reduce the number of SKUs and drive more higher margin SKUs through that business? So that's another way that we think about consolidation. As Ben mentioned, if we're able to consolidate warehouses, to consolidate operations on that side of the house, when we look at standard fulfillment costs as a percent of revenue, we run incredibly high relative to where we think we should be over the long term. So we think there's real room to drive efficiencies through that, but going back to that consolidation point, we've got to really figure out how to kind of tie all this together, both from an inventory perspective and from a systems perspective.
Okay, thank you.
I'm showing no further questions in queue at this time. This concludes today's conference call. Thank you for participating. You may now disconnect.
All right. That was a lot. So 5:50 Eastern. We started this around 4:30. I think we'll let it run till around 6:15, 6:30. I'm also hosting an open mic on my personal account at 7, so folks are welcome to join. It won't be PLBY related. So we got a little bit more detail. I think the most interesting thing I heard from that entire Q&A had to do with the substantial progress towards a joint venture with an operator in China. For those who aren't intimately familiar, their Chinese business, they have licensees, a few that are both like manufacturers as well as kind of, I guess, sellers. There's several different licensees in China. And they generate something like 40 plus million in revenue from Chinese licensees. And that's obviously licensing revenue, high margin revenue. So it will be interesting to see what comes about, if anything, from a change in the structure of their relationship in China. They talked about the Centerfold the platform will be rebranded. They're calling it a Playboy creator platform now. Ben was saying that, quote, it will be our magazine of the 21st century. And he asserts that they know what the consumer wants. And that they've accelerated creator onboarding in the past few weeks, although the data points that were shared were pretty sparse. They made some allusions to 70% of creators making more than the previous week, but it's really hard to have context for when he's referring to with that, and noting that the number of actively paying users has doubled and is growing week over week. But again, no absolute levels provided. The assumption that they're at extraordinarily low levels to begin with, especially in the context of how much time, energy, and treasure they've invested in this initiative. So unfortunately, for those of us who view the ongoing focus on Centerfold as a boondoggle, it looks like Ben continues to double, triple, quadruple down and tie the fate of the business to his desire to recreate an OnlyFans competitor, which again, they have the brand. He's right about that, but they certainly don't have the other competencies necessary. And I'm not very hopeful for that business's outlook, barring some shift in how they decide to go to market. Really, they should have just licensed the brand to OnlyFans. And maybe hindsight would have been 2020 with that one. But they alluded to removing 18 million of annualized operating expense, and I think the number I heard was that their annual expense rate is at 165 million. So the 10Q did come out during the call, so I haven't gone through that just yet, but I did see that came out. But I know we've obviously got Jimmy up here as speaker. I know there's a few other folks I see in the listener who have spoken with about the stock in the past and who are shareholders. So if any of you guys or gals do want to come up and chime in, you're certainly welcome to. But definitely, there's real risks, interest rate risks, given that their term loan is LIBOR plus 6.25%. So Lance noted next year debt service costs will go up by 10 million or more. So there is certainly a challenge there that they need to overcome. And they kind of demurred when there was the question about asset sales. They did talk about Yandy being, what was the term? Reviewing strategic alternatives for Yandy. Yandy, of course, is Yandy.com. It's kind of a wholesale costume model. They bought the business for think it was 25 million or 45 million in the end of 2019. It gave them the necessary infrastructure in terms of having a fulfillment operation to actually do direct to consumer, because prior to that, they did not have a direct to consumer business. So, that does not appear to be something then that they see as a need going forward. They kind of alluded to Yandy being the main laggard in terms of revenue, with the impacts they had noted in the preceding quarter about iOS kind of really jacking up their customer acquisition costs. So they made allusions to the prospect of the email lists that they've been gathering from Centerfold/Playboy Creator Platform signups that they have not yet leaned into advertising and trying to cross-sell those customers. So that's a prospect. And then just from a balance sheet comment, they have 65 million in cash and restricted cash. 60 million is cash, 5 in restricted. And they do have to maintain a 40 million cash balance per the terms of their amendment, their amended term loan covenants. So, Lance is asserting that they have financial flexibility to remain within the amended covenants, and that they expect cash flow from operations to be roughly neutral through end of year. So, licensing down a bit. Also, just some of that, is their retail partners, right? Their PacSuns, obviously misguidance now out of business, and their Chinese partners are not, none of those partners are really sending them overages like they were receiving in the preceding year. So licensing was down 13% year over year from those reduced overage rates. So it's a tough environment for them, and it's a rough result. The shining point is that Honey Birdette would have been up 41% in constant currency. It was up 34% year over year. So 21 million in third quarter revenue. That business is close to $100 million revenue run rate, I would say. And that they did see 22% of sales of the newly launched Essentials collection were to the brand buyers for Honey Birdette. So that is positive. It remains to be seen how resilient Honey Birdette buyers will be as the economy and the headwinds continue to, the economy continues to deteriorate, those headwinds rise. But yeah, I guess kind of all over the place with that. But they really, at the end of the day, are simplifying their business to reduce operational complexity, to revolve around Honey Birdette and Playboy, and with that belief that the investment in their creator platform is crucial. So, good results from the core brands, poor results from Yandy continue, and then obviously the big goodwill and intangible asset impairment charge as a byproduct of interest rates rising, and not good on the bottom line, but you can only write down assets so many times, right? But yeah, a lot of folks in here listening. Feel free, anybody, to put your hand up if you want to chime in and speak. Jimmy, you're certainly welcome if you'd like to chime in and share your takeaways, if there's anything you'd add to what I was sharing.
Yeah, I had a question for you. I mean, do you any changes at the margin, pre-call, post-call? Anything surprise you?
I'm surprised. I mean, I am and I'm not surprised, I guess, in the same breath, about how utterly and completely Ben Cohn has tied the company to this creator initiative. So, they've shared a couple of, trying to weave a positive story about it, but it gets back to, Honey Birdette is doing great. Why did you pause growth in that business? Why are there the same number of stores now as there were when you bought them in, at this point, almost a year and a half ago? So I think that there's an issue with prioritization at the management level. They're prioritizing the wrong thing. And it does not appear that the CEO is interested in hearing other people's opinions. So it does appear that there will need to be there may need to be action taken if you want to change the course of events here.
Yeah, on the store opening, I do think that just with the retail calendar, it made sense for them to try to open up later in the year versus early in the year. Perhaps you've been to the Tampa location already.
No, they haven't opened it yet.
They haven't opened it yet. My expectation or my hope is that they can really get that done for the holiday season, obviously, or through Valentine's Day. So it's kind of a Q4, Q1 type of impact. I think I'm looking now direct to consumer. It's almost 70% of their total revenue. It's got a strong margin. One could say, if we really want to simplify that brand alone, the Honey Birdette engine is probably worth the business. There's a lot of extraneous factors. I did hear, and maybe I'm wrong.
Yeah. So before you go further on that, to step back on Honey Birdette, they paid for the company in the form of both cash that they raised. For those who are newer to this story, remember, yes, this company came public via SPAC, but unlike most SPACs, they A, didn't have warrants, and B, they raised incremental capital in a follow-on. So they raised over $200 million at $46 per share.
Brilliant.
That they used that as well as some equity to buy Honey Birdette last year. Now, they certainly paid a hefty premium. They paid 12x EBITDA, which I think it's safe to say that EBITDA was in part inflated from COVID. But if they're at let's say that 100 million run rate is roughly right, and that they're at let's call it a 35% EBITDA margin. So let's call it 30 to 35 million in EBITDA. This is a very high margin private label lingerie business and sex toy business. I don't see that being sold for less than 5 or 6 times EBITDA, which obviously, if they were to sell it, not that they've implied they would be, but that would be equal to, more than the market cap is what they could actually sell the business for.
Yes.
Now, granted, there's the debt to consider. That's obviously a real cost, as we mentioned, and Lance mentioned the incremental 10 million in interest expense they expect next year from it. So, they do have options. It's not like they are about to go bankrupt overnight. There's certainly options, although if things get, if the consumer does begin and continues to, what's being seen on the lower end consumer spreads to the higher end consumer that Honey Birdette targets, then I think that's where you get concerned, especially if there were to be some further issues with Chinese payments. But it does sound like there's some progress made toward that JV, as they noted. So, sorry, Jimmy, I didn't mean to cut you off.
Yeah, that was good clarification. I mean, again, it's such an integral part of the company. I don't think that's not for sale. They talked about trying to transition lovers into Playboy Pleasures so that they can also upsell. It's an easier upsell to have a Playboy branded store and to throw in a couple of Honey Birdette items in there than to go from Yandy to do something different. If I didn't mishear, on one of the responses in the Q&A, Lance talked about, without giving 23 guidance, he said, hey, our goal is to still run this at a break even and to reinvest the cash flow we have from the core business, which I think is positive and strong, and I like all that, into these initiatives. So, again, for me, is like, if 23 is another break-even year from cash flow, we get a little bit more dilution, but there's some brand momentum, I'm willing to live with that. At $3 a share, I mean, I'm a buyer all day, right? I think there's only so much incompetence, so much money that can get wasted. And I'd like to think if there is a continued macro slowdown and the top line shrinks, that they would have to cut back on some of this reinvestment. But I think that at least from the management side, it's been clear all year that they're putting a lot of money into these investments, and I don't know what the return is on that today. It doesn't seem very high because of some of the missteps. But coming out of this, my biggest fear was that they would run out of cash. So I think 65 is a lot better than maybe the 50 million whisper number I had heard. That in itself is already like $1.30, $1.40 a share at today's price. And again, just having seen a couple of these retail earnings so far, this is not bad. This is probably in the top 50. I don't know if this is like top quartile, but certainly in the top half. for me, I can still rest on Playboy and Honey Birdette, and this company is still, in my opinion, deeply discounted. So I don't think my thoughts have changed there, but I do think that the fourth quarter will be very telling.
Yeah.
Hi,
Ara,
everyone. Hey, how are you? Thanks for hosting this event, by the way. I mean, I think we should do it after every quarterly call, and maybe even talk more often. I'm a large shareholder. I have basically expecting this result. I sold some of my shares in, let's say, around 350. After the call, after I saw the earnings result, it was again disastrous. But listening to them on the call, I have to go through the queue now to see what is in there. But the call was, as usual, positive. I would say it's more positive than the last quarter's call. I mean, I would agree with Jimmy. I was expecting lower cash number, so 65 million is not that bad. But the problem I see is regarding monetization of Centerfold. I mean, when are they going to start charging basically their 20%? Which
that's in place. There's just not people there. It's just immaterial, right?
Yeah, I think. I mean, I remember from a couple of calls ago, they said they weren't charging yet. To tell you the truth, I would be really surprised if they had any revenues from even $1 or $10. You know, I don't think they've started charging. And it would be interesting to see when they will start charging. Also, another thing another comforting thing was Honey Birdette and Playboy doing fine, and the revenue shortfall is mainly due to Yandy. I mean, even if they were to sell Yandy, I don't think they'd get any money at this point for the Yandy.com website. I mean, maybe 5-10 million, but not what they
that's
paid
exactly
for.
What I had in my liquidation value, like 5 million, maybe 10 at best.
Yeah, exactly. So, there are some even before the earnings release, I was really negative. I mean, I was thinking, probably we're going to go to a restructuring kind of an event. They didn't release the earnings. They usually, I remember, release it a little earlier, but they released it at 4:30, right when we started to have the call here. So none of us had really a chance to go through what they basically released. But as usual, they don't release much. I mean, they just released some revenue numbers and Ben's comments, right? One of the things that gives me comfort is this product lady. I think she knows what she's doing. I mean,
Ashley is definitely the best asset they have on the human resources side of that company right now. It seems to me as well.
Yeah. When they hired her, I was also I thought it was a good hire, even at that time. But I don't know what they're paying her. I mean, share-based compensation, because I don't think she would be let's say cheap hire. I'm sure they're paying her a lot. But I'm kind of looking at this story for Meta. where Meta makes a lot of money from their core business and shoots it into metaverse. Uh, like the returns aren't there, right? If these guys, make what they're claiming they're going to make, and we all know, right? Honeybird that makes money. Royalties are extremely high margin business, so there is some cash flow coming through, and if they invest that money wisely, like besides this centerfold thing, the adventure, I think opening Honeybird stores, which is like 30 plus EBITDA margin business, I think makes sense. But let's
Right,
see.
and just to add, we heard them talk about a new Boca Raton store. That was the first time we heard about that they expect to have open by mid-23. And they did allude to some European and other stores by late 23. So it does sound like they've at least moved forward in some growth on the physical HB storefront, like as you noted, the 30+% EBITDA margin and four walls. So that's good to hear.
Yeah, like they just need to focus a little bit on the cost, right? 165 million. I mean, I'm going to try to come up with the details of what that potentially is. I mean, from their Q, etc. But one thing about this 25% product cost. So I was thinking, does this product cost also include the royalty business? If they make 300 million in sales, so the product cost is 75 million. So does that include the physical product, or does it include also the brand product? So if they do 300 million in sales at some point, with a 25% product cost, which is 75 million, plus the 165 million in total annual capex, OPEX, that gives them around 60 million kind of an EBITDA number at some point. I just made up the 300 million number. I don't know when that will happen. Hopefully, I don't know if it'll happen in 23, probably not, but potentially in 24, opening more Honey Birdette stores, the macro helping. So it could. I mean, it's at this point, it's a bet, right? I mean, when I first got into the stock, I mean, everything collapsed. I mean, Jimmy is right. I mean, many of these high-tech stuff collapsed, right? I mean, Meta going from 350 to 85. I mean, why shouldn't Playboy go from 15 to 3? I mean, it sure can. But
90% year to date net of after hours. A little over 90%, excuse me.
Yeah, but we all knew, right, that $30 was not the right price for the stock. I mean, it traded there with the Bitcoin and NFT, rabbitars, etc. But for those of us who are making like real analysis and looking at the true EBITDA, right, 10 to 12 times potentially, if the business was on a like proper footing, would make sense. I mean, and they were always guiding 350 million in sales in 2025. I was putting kind of a 20% margin on it, 70 million EBITDA.
600 million to 25, right?
Yeah.
It was 350 for this year before they withdrew it.
Yeah, 350, 600 for 2025, 350 for this year, 20%. That's 70 million, 10 times, whatever. Take it. I mean, $12 when you take the debt out of the picture, right? But unfortunately, along the way, there were many. Mistakes made, right? I mean, they raised money to buy back shares.
Oh yeah, we didn't hear this quarter. What we heard last quarter was Mr. Cohn telling us all about how excited he would be to be buying more shares once he was able to, and there's not a whisper of insider buying. There has not been insider buying. I guess the bright sign is there hasn't been insider selling. So he wisely opted not to bring that up this quarter, although I think it's safe to say we won't forget what he said and his actions relative to his words. But look, I think you're right. Getting the full result, it looks less bad than the initial I think result implied. Clearly, the core brands are still pretty healthy, but for the costs that they're facing. So I mean, it's definitely going to remain, I think, hated, right? It's a SPAC that has drawn down meaningfully, that has poor corporate governance, that most institutions are uninterested in considering due to those factors alone, beyond just the uncertainty around when do they achieve profitability. It's one thing to say that you think you could be profitable today. I don't know that I necessarily believe them, but if they can actually execute and come through with a year of performance and actually get anything out of their creator platform, then yeah, clearly there's upside from current levels considering those things. But I'm just not of the view that this management team is capable of executing on all of the things they're trying to execute on. And it seems that the market is in agreement with that stance presently. I'm also of the view that if Ben Cohen were to resign, the stock would be up 50+% that day, because it does seem like there's a significant overhang there, but could be wrong.
Yeah, agreed. What can I say? I mean, I've ran many companies in my career, and if I performed anywhere close to this, I would have had the decency to resign myself. I mean, it's been crazy, right, for all of us. But I don't know. I mean, the shares I sold around 350. I'm more inclined to buy them back and go back to my original position potentially, but we have to see what the market does tomorrow. I mean, I'm looking at the screen now. I mean, there are some big sellers at 310, 315. I don't know who these people are, but there's still some sellers out there, even at these prices. And I'm not surprised. I mean, some people would like. I sold at
I don't know if you
350,
called the
right?
conversation earlier. I tend to think, right, like we just said, the stock's down 90% year to date, give or take. So over the next 40 or so trading days, any folks who are trying to lock in a loss will be looking to do so if they haven't already. And I don't think this result gives people the confidence to, at least at first blush, right, the stock traded off in after hours down to 261. It has rallied a bit in after hours with a little bit more volume on the recovery. So it's at around 3, I guess, is the last trade that I'm seeing. But still, that creeping dilution. So that $3 is now on. Let me go back to the top of the queue to get the actual number. Is now on 45.8 million as of November 3rd. So.
Yeah, the one thing I've always worried about this company is
share-based comp.
The problem I see is, what if they take it private at like $4 or something? I mean,
there's a way they could alleviate that. They could simply sign a standstill agreement, and they have opted not to. So if they genuinely didn't wish to take that action, they could sign away the rights to take that action, which I think would be a huge boon to the stock price in the short run. But we've not seen that out of Rizvi Travers, so I doubt it's coming. But that's an option. And your concern, I share that concern. I mean, I know some investors have a view that this has been a purposeful tank and that this is a coordinated, controlled burn in order for them to take the company private at depressed valuations. whether that's true or not, it's certainly something that many shareholders have voiced a concern about to me. And as we've disclosed that Wook has a meaningful position, our share count is in the 7 digits. So we are one of the largest shareholders, and we certainly retain all options available to us in order to protect our investment and that of other shareholders. I have not spoken with Ben in several months, and I don't intend to speak with him. I don't think there's anything constructive to come out of it, but it remains to be seen where things go from here.
Who are the largest shareholders? I mean, have you guys tried to?
I've spoken with most of them,
others.
Yes.
What is the total amount of shares
I can't disclose
you've reached
that.
out to? Oh, okay.
But I can say that the consistent theme is that management is the core problem, not the assets.
Yeah, I mean, just take the royalty business and the Honey Birdette business, and that's a lot more than where the stock is trading now. The problem is the debt they have, right? I mean, it's expensive debt.
For sure.
And the preferred equity they issued to buy back the stock, which has a crazy amount of, again, dilution provision for us. So,
right. I think that alone, to me, was grounds for the CEO to go. Right. For those who don't remember, in May, Playboy put out a press release that they would be authorizing a share repurchase, and in conjunction with that common stock repurchase program, they also authorized, or rather, they had a private placement of preferred stock. So they sold 25 million in preferred stock. They authorized up to a 50 million in common stock repurchase. They then went ahead and drew down the balance of that preferred stock the day before the third quarter, the same day that they had an amendment to their term loan covenants. So something happened between May 17th when they had Ben Cohn say that, quote, "This repurchase program reflects our confidence in our reimagined Playboy brand, transformed business model, and progress against our long-term growth initiatives. We believe this is a great opportunity to create long-term sustainable value for our shareholders." And then less than 100 days later, turning around and drawing down the balance of the preferreds without executing on any of the repurchase. So, credibility absolutely destroyed after just that alone. Beyond the other things that have been going on, at least in my view.
Yeah, you're totally right. And the Dream acquisition, and then that fiasco.
Right.
I mean, how can you buy an asset like that for that much money and then scrap it like 1 month down the road? I mean, they should have done their homework better and not bought that thing. I mean, they rushed it. I mean, they rushed the centerfold product so much. They should have studied it better. I mean, they tried to get this minimum viable product into the out there, and they screwed up.
In hindsight, we could look back and understand what was attractive for the actions that they did take. I think your point about the lack of due diligence is the glaring issue here, that they certainly were very loose with shareholder capital in 2021 in both paying the price they paid for Honey Birdette, which I'm not arguing it isn't a great asset that's strategically important. I'm arguing that maybe 12x EBITDA, which was also something like almost 5x revenue. It was a very rich valuation. But regardless, the Dream buy, 30 million in equity, which granted that's wasn't cash, so that's maybe better than not, but they did not do their homework. But it was in August of last year that OnlyFans had implied that they would be kind of shutting down the X-rated portion of the site, which, it seems like they just reacted and rushed and didn't thoughtfully contemplate how are they going to get to market with something. Maybe they should have opted to partner with an existing player, a Patreon or other, a Fansly, and license out their brand, given that is what the asset really is, the brand. They had no technology competency to try and build their own creator platform. They're obviously have brought some tech folks in-house now. Whether they'll be able to deliver, from what I've seen from the product, from talking to people in product, they've all consistently said that this should have been shut down a long time ago. There's no reason for them to continue to put good resources after bad, but clearly listening to the CEO, he sees otherwise.
I don't have any clue about their other assets, artwork, etc. Is there any value there? I mean, do you know?
Yeah, I did some work on the artwork side. Obviously, Playboy, before they were taken private by RISV in 2011, was a public company. Remember, it was a media company with a licensing business. So they had talked about in a 2007 quarterly earnings call that they had the artwork appraised for $20 million in the mid 2000s. Granted, they've sold some since then, and I don't have. I tried reaching out on Instagram, as a matter of fact. Talk about due diligence. I reached out to the former curator of the collection, but I was unable to get in touch with them to try and understand how, their thinking about the collection. But I've heard estimates thrown around from 10 million to over 100 million for the artwork, which I again don't understand why they haven't monetized it. The art market is still hot. It's not nothing, right? When you think about how much they're spending in interest, I would certainly prefer they liquidate, say, 20, 30, 40, 50 million dollars worth of artwork to stop paying this expensive debt. But again, they no questions about it in this past call, no discussion from them. I think in the last call, they mentioned there were no sacred cows and everything was on the table. Well, great. They did sell the jet, which I think is in part because of my badgering of them on social media about the jet. But they have yet to sell the artwork. And of course, the day after they sold the jet, the Friday into the Labor Day long holiday weekend, they also released a $250 million registration statement. So I heard from others that were scared off by that they viewed it as a quasi-poison pill. So whether that was the intent or not, they've not explained it. And that's how it was taken by other people in the market that I've spoken with.
Yeah, that was also a surprising press release. And they haven't done anything with it, right? So far.
Right.
Yeah, now we're looking at the $3 stock. So thank God my coal investments made a lot more than I've lost here. So it's been a good year. But are you guys following Hedgeye? Have you talked to them?
I've spoken with Brian and Jeremy on several occasions. There's still a bullish tinge, I think, to their view. I know they met with management in LA a couple months ago. I'll be curious to see how they react to this. They'll probably say something similar to the kitchen sink about the impairments, perhaps. I don't know. I haven't spoken with them today. But it's tough. It's tough. You don't want to capitulate at the bottom, right? And it's tough.
No, to tell you the truth, this impairment, for us investors, who are looking at the future and trying to forecast the future potential of the company, this impairment, it doesn't affect me a bit, except the headline, right, which may have on the stock price. But I was kind of relieved with their cash balance and the Honey Birdette and Playboy brands doing fine, and Yendi being down 50%, So if they took out Yendi and looked at the business like just for Honey Birdette and Playboy.com.
But that gets back to the difficulty, right? That the company doesn't disclose in that manner on the Q. They only break it down to licensing and direct to consumer. So it's really difficult to break out the individual contributors to value, which, that's where it gets overlooked, of course. But in terms of, if somebody's going to try and pick this thing up who's never looked at it, I think it's really difficult. And I'm certain it lands in most folks' too hard pile very quickly right off the bat. So, hopefully we'll be rewarded for bearing this pain as investors in this security. But, there's definitely very real risks. They mentioned the elevated inventory levels and the fact that they're going to be competing for dollars in this, challenged environment in the fourth quarter. And it's not unique to them in the retail space, but I'll be much more interested in seeing the fourth quarter result. This result obviously was weak and noisy, but the fourth quarter result's really what matters, since they have so much of a contribution from the holidays that'll really inform, where they sit from a cash perspective and heading into 23. And obviously, just again, from a timing perspective, any proposals for the annual general meeting must be submitted. I think it's due right around when the fourth quarter result comes out, but obviously need to double check on that.
Yeah. I mean, there are no surprises, right? The stock has never gone up, except in the very beginning. So it's been a straight way down. So it's down again. So what's new?
I mentioned like many months ago, I mentioned that this was giving me a lot of GameStop 2019 vibes, which the stock went from 16 in the beginning of 2019 to 3 and change by August 2019 before Burry wrote the board and things changed a little bit. But I think in this case, it's maybe a little bit similar. Some of us see value under all of the shitty results and headlines, but many aren't necessarily digging that deeply, and it's a lot easier to skip this one. But who knows? We'll see what happens.
But what do you think?
I'm going to wrap in about 10-15. So if anybody else wanted to ask any questions or come up and chime in, please do so. I do need to take a short respite before at 7 o'clock. I'm going to be jumping on my handle for a market open mic. But sorry, Arda, go ahead.
Do you see any bankruptcy risk anytime soon?
Well, look, the term loan is not, 2027? I mean, it's expensive, and they need to do something about that, I think. But in terms of, and look, it gets back to the fact that you do have a core licensing business that generates meaningful cash for you that doesn't cost you anything to, from a CapEx perspective, it's a no capital to continue to draw out those cash flows from your Playboy Bunny and your Playboy, masthead that, generating 1.5 billion in sales in China. And sure, they're only getting, 40 million or so in revenue off of those end sales, but it will be interesting to see what developments come about from this joint venture prospect. I don't know enough about it. That was the first we'd heard about it to know what the implications would be there. But the way I see it is they have enough cash coming in the door just from licensing that if they were to rationalize spend, bankruptcy should not be a concern. But anything can happen. And if China invaded Taiwan tomorrow, this business would be bankrupt. Yeah. But I don't think that's going to happen. But anything could happen.
Yeah, okay, great. Thank you. Yeah, anyone else? I mean, it would be interesting to listen to other views as well, Jimmy, what do you think? You're quiet.
Yeah, I mean, I think you made some really good points. I've invested in other companies, and I think on the back end of this liquidity bubble that we're kind of coming out of, we talk about factor exposures. Because of its Rabbitars project and Playboy having some Ethereum on its balance sheet, I think last year it was added to this crypto ETF. It's ridiculous, right? But when I think about the market today, SPAC exposure, high beta, consumer discretionary, apparel, crypto now, it's got all the bad factor exposures. And so there's hundreds of companies that have, irregardless of their business, that are down 90% from their peaks. So it's hard for me to ultimately, like, Ben has made some capital allocation missteps. He still comes off very much a salesman. This is kind of like a lifestyle job for him. But when I analyze the performance of the stock versus the business, it's hard to pin. I wouldn't even pin 50% of this on Ben. And for me, looking at how a lot of other companies have traded, how they've been discarded, we're in this market where if you are of a certain size, whether it was inertia or legacy, and you're in an index, you're in some type of benchmark, you're trading at a different multiple, and your results are just as crappy. And then we've seen a ton of fallout this year where just a lot of businesses are down 90% priced for death. And frankly, because there are no sizable institutional shareholders left in the name, it's hard to kind of back into what valuation and what price implies. Price always drives narrative. But frankly, when I look at a company like Playboy's stock price and I look at other consumer discretionary, other de-SPACs, these companies are priced for death and or massive dilution. And honestly, I don't see that in either case in Playboy. I mean, Playboy's getting diluted, but it's holding the line. It has a strong core business. It's four-wall profitable. It has the brand, like we talked about GME a little bit. But it doesn't, you can go long this and short another de-SPAC that's down 90% if you really want to. I don't see this company going bankrupt. I think there's definitely something there. I think it's blowing in the wind like most other small caps, micro caps in this tough environment. And so on a day where there's no institutional buying and there's a crypto blow up and it's in a crypto ETF, I mean, that's just selling pressure all day.
Yeah,
and
I'll add on that, Jimmy.
Yeah.
And you can finish your thought. I don't mean to.
That was the gist of it, right? But we've been there. Yep.
Yeah, just to add to your thought, I spoke with another investor, actually the investor who put the stock on my radar initially in the first quarter of 2021. But he noted that he's spoken to a dozen hedge funds that are short SPAC baskets, and they don't even know what's in them, was his comment. The speculative high growth basket is just getting shorted, like you noted, as a fact. PLBY as a short, and he noted the correlation between true frauds and PLBY was, at least at that point in time, was around 90%. So his take was sort of similar to yours. Maybe he thought a little more was on them. He said like 35% was outside of their control. So, maybe a little bit more onus on Ben and Co. versus your perspective. My perspective too is, look, you can't separate the reality of what's happened in global economy and in other business valuations, especially of that factor. So like I obviously knock Ben a lot, and I still believe he must go, and that there's no recovering from the various failings that he's exhibited during his leadership tenure of this newly public enterprise. But that's not to say that he's the only issue. That source I trust very much. He had a conversation, with Lance and shared some good detail with me. So, I get it's not all on them, but yes, this ticker is certainly lumped into profitless, high beta, SPAC. It has all of the wrong things, so that I don't see any imminent catalyst for a re-rating. But getting back to the issue, do we see it going to zero? I don't see equity going to zero. So we're going to probably be in a little bit of no man's land through at least year end, right? There's no reason to see the real economy shifting meaningfully. I think between now and then, we're going to get the Fed one more time in December, and we're still not at terminal rate. Consumers are still getting pinched, so we'll see how their consumer holds up when the fourth quarter results come in. I'm gonna take that, Jimmy. I'll let you get the last word, though.
Sure. I'll just posit one last thing, right? Like, imagine if Ben and the rest of the Playboy team did not buy Honey Birdette with their extremely, well-priced cost of capital last year at $40-something a share. Then I think this company has a real chance of being a zero. right? Because that's driving their business today. And they were able to arbitrage their cost of capital into buying a premium brand that actually has something. So, that's that's a minor positive, I suppose. This would be a much, much different story if the price had gone up because of all the factor exposures anyway last year and they hadn't done something.
It would be interesting where the price would be if they had just raised the money and held on to it. Right?
Yeah, but then you wouldn't get the high margin revenues.
No, I think long run, Honey Birdette is certainly, if they can hopefully get their heads out of their asses with regard to the failed creator platform, that's the real question mark, is when they will realize that's dead and floating in the water face down. I don't know. Ben sounded pretty committed to it in today's discussion, despite not sharing any meaningful numbers, a year on. So we'll see.
Yeah, I wish they shared like how much like kind of Meta is doing, right? Reality Labs, how much they spend, like what is the burn on this centerfold adventure, who knows?
Yeah, I
But
think
maybe
it's even less. It's even less a matter of, I think, the direct cost. To me, it's just the massive opportunity cost of you having the CEO and however many others investing a lot of time and energy in this when there were a lot lower hurdles that they could have jumped.
No, true.
But we'll see. Anyways, it's 6:41. We've been doing this about 2 hours now. So thank you, everybody. Arda, Jimmy, very much appreciate you guys chiming in. I know we've spoken in the past, and I appreciate your perspectives, guys. And then for folks listening, thank you very much. This is something that we obviously will continue to do on behalf of Wook Capital as investors in the security. We will continue to host these quarterly calls. And there may be more from us in public on this security to come in the near term, but keep your ears and eyes peeled for those potential incremental details. So I'm gonna wrap there. Thanks again for tuning into this third quarter 22 Playboy earnings discussion and conference stream. The replay will be available both on Twitter, and Joe is gonna make it available on the Wook Capital YouTube for folks to check once Twitter removes us after 30 or so days. So thanks, everybody. This has been Rod Alsman, Managing Director at Wook Capital. Appreciate everyone's time for tuning in. Have a great night.